Hello, everyone. My name is Mark. I am the stock market jobber. Thanks for tuning in. We're going to talk a little bit today about momentum, and I just want to give you a little bit about my background. I was head of trading at three different institutional money managers, where everyone, all three of them managed in excess of $1 billion. I was also traded directly for Steve Cohen, who's probably one of the greatest traders of all time, who now is the owner of the New York Mets baseball team, and also Mario Gabelli. I traded directly for him. He hired me out of business school. He's one of the greatest value managers of all time, or buy buy and hold managers, I guess you could call them. So I've been pretty lucky and pretty fortunate to it's like you take piano lessons from Mozart and like Beethoven, right? To learn from these two of the greatest in history. And at this point in my career, I've decided that I just want to teach people because I see so much instant misinformation. And, I look at some of these other trading classes with I guess, my quote unquote competitors, if you will. And I mean, most of the stuff out there is just absolute garbage. It's like this, you know, Fibonacci stuff, Gann theory, LA. That stuff is science fiction, okay? In the institutional world, no one pays attention to that stuff. No one even talks about it, right? In the institutional world, we focus on pretty much four things, and this is what I teach at Stock Market Jobber, and this is why you should subscribe to our YouTube page here, okay? We focus on what are the important price levels, what's the trend, what's the momentum, and what's the psychology. And that's it. It doesn't need to be as complicated as you probably think it does. So today I'm going to focus on momentum. Now, what is momentum? Momentum is a measurement of how far a market or a stock or an ETF. I'm just going to kind of defer to say stock because that's my default because my background is as a stock trader. But it's how far a stock has moved in a given period of time from point A or time period A to time period B. Now, most of the time, a stock is within its typical or normal trading range. If for some reason it gets aggressively bought, it gets above that range. We call that overbought. If it gets aggressively sold, it gets below that range. We call that oversold. Now, why is this important? Well, if something is overbought, it'll attract sellers into the market because they're going to be expecting a reversion back into the average. If something is oversold, it's going to attract buyers into the market because they're going to be expecting a reversion. So a lot of trading models on Wall Street are based on this concept of reversion to the mean. So there are different ways of measuring momentum, and I'm going to go over a couple of them here. Now, there's literally hundreds of ways to measure momentum. And I don't think any one is any better. Well, actually, there are some that are better than the others. But I think what you really need to do is pick maybe two or three and just get really comfortable with them. Okay? Because there are little nuances, different things work at different times. Me personally, I've had great success over the last 2 decades just with two simple, basic indicators or oscillators or whatever you want to call them. I like to use the Bollinger Bands and I like to use RSI. It doesn't mean they're the best ones. You might look at something and see it in a different light. You might have a different eye for a different thing. So again, my advice is pick two or three and get really comfortable with them. I see a lot of new traders on their screens. They'll have like five or six different momentum oscillators. And maybe in some kind of way it looks cool, but I don't think that's a good way to make money. So anyway, let's just start off here with AMC. And down here we have what we call the relative strength index or indicator or index. No, it's relative strength index. So this is what I like to use. It's simple, it's effective. Basically, what happens is, or what this shows is, if the blue line gets above the red line, it shows overbought conditions. If the blue line gets down close to or below the red line, it indicates oversold conditions. Now we can see here AMC is overbought according to this oscillator or this indicator. We can see, right, whenever it gets overbought, it tends to reverse. Okay, here. And the reason why I wanted to start out with this is because I know a lot of you are probably trading this, and notice how it's up against a resistance level. Stocks that get to resistance or markets, and I'm just going to say stocks as my default, but it applies to any financial market. Stocks that get to resistance while they're overbought tend to reverse. Okay, resistance here was overbought, tends to sell off. My guess is AMC is going to go lower. I mean, it's not a trade recommendation, but overbought stocks that get to resistance tend to sell off. All right, you can just tell yourself that 100 times, like it's like a Buddhist koan or a mantra. And the opposite is true on the other side. Overbought stocks that get to resistance tend to sell off. But anyway, before I move on to the next chart, I know we're just talking about momentum, but I got to throw in something about levels here. Notice how the level that was support converted into resistance. Why is it that a level that was support somehow kind of amazingly converts into resistance? It's because of buyer's remorse. When we look at a chart, we need to understand that we are looking at a graphical illustration of psychology, human psychology. Support becomes resistance because people experience buyer's remorse. There's a lot of investors who bought AMC here who thought they made a great decision when it went higher, but once it fell back below their level, assuming they didn't sell it, a lot of these investors tell themselves, I made a mistake. I shouldn't have done this. I'm going to get out, but I'm only going to get out if I can get out at break even. So if it rallies back up to my buy price, I'm going to place a sell order. If we have enough remorseful buyers placing sell orders at a level that was support, the level that was support can turn into resistance. And we had resistance here. It looks like, at least for now, we're running to resistance here. So just remember that. I know I want to kind of just focus on momentum, but this is a mantra. Oversold stocks that get to support tend to bounce. Overbought stocks that get to resistance tend to sell off. All right, let's go look at the next chart. This is another way of measuring momentum. There, a lot of it. Here's the thing: these momentum indicators, there's dozens of them. There might even be 100, if not more. They're just different ways of measuring the same thing. So it's kind of ridiculous to just focus on too many. Now, the red line here, these are called Bollinger Bands. The red line is 2 standard deviations above the 20-day moving average, and the red line on the bottom here is 2 standard deviations below the 20-day moving average. Now, if you'll notice, if we exceed these thresholds, we tend to reverse. We got below it, we went higher. Got above it, went lower. Got below it, went higher. Above it, went lower, so forth and so on. Why is this important? Well, a lot of the trading algorithms nowadays are based on this concept, are based on statistics and probability theory. Statistics and probability theory suggest or tell us, I don't know, I'm not a statistician, just a stock market guy, but that 95% of all trading should be within 2 standard deviations of the mean. So if we get above or below that threshold, it's just like the RSI. It's a different way of measuring the same thing. If we get above it, that draws sellers into the market. If we get below it, that draws buyers into the market. So this is a different way of measuring. Now, me personally, I've had great success over the years with just a simple RSI and a simple Bollinger Band. When I say simple, I mean just using the default settings. So what I really just want to suggest to you all is just, pick 2 or 3 and get really comfortable with them. RSI and Bollinger Bands work for me. Something else might work for you. There's really not a right way or wrong way to do it. Everyone has a different personality and everyone sees different things. Now here's Citigroup with the RSI. Now here's something that I did. Now a lot of people don't understand that you can do this. The typical default setting for the RSI is if the line gets above 70, it indicates overbought. If it gets below 30, it indicates oversold. Every stock is a little different. And what works on one may not work on another. Now, what I did here is I went into the default settings and I changed the upper band to 65 instead of 70. And now I'm getting more signals, okay, that are accurate. 70 is just the default. 30 is just the default on the downside. Different stocks act differently. Every stock has had its own personality. So a conservative stock that doesn't move that much might be overbought when the RSI gets to 65. A really volatile biotech stock, it might be overbought when it gets to 75. So these indicators are not set in stone, okay? You can mess around with the default settings. And I know for a fact, because I've seen it, that there are funds that pay tens of millions, if not even more, dollars to kind of optimize this stuff. And you know what? They're no better than just someone like yourself just sitting there and eyeballing and saying, oh, like, oh, gee, I like to trade XYZ. I've noticed that on XYZ, overbought and oversold are 65 and 35. My other stock, ABC, which is much more volatile, well, for it to be overbought, it's got to be at 75. It has a different personality. Or for it to be oversold, it needs to be at 25. So every stock is a little bit different, and it's okay to mess around with the default settings. I just want to point out this thing here. I know we're not talking about levels, but I can't help myself. Support becomes resistance, buyer's remorse, right? Investors who bought here regret doing so when the price went lower. They place their sell orders at the same level they bought at. We can see this all the time. Look at this. Support became resistance here. Investors bought here. They regret doing so when the price goes lower. They place their sell orders at the same level they bought at. Support becomes resistance. I mean, you don't need to be a chart guru or a former hedge fund trader to see that. Some price levels are more important than others. That's just the way financial markets work. And if you understand what we're talking about, levels, trends, and momentum, you're going to be ahead of 95% of your friends who do this. But let me just stick to momentum. You can check on stockmarketjobber.com for lessons about levels and different things, what hedge funds really are, what market makers really do, because there's so much misconception out there. When I left the institutional world, I didn't really know what to do with myself. And after a year or two, I decided to teach. And now that I'm in the retail trading world, so to speak, it really kind of just amazes me. And it really saddens me how much misconception there is out there. All right, anyway, let me just go off my rant here. Now, I just wanted to show you here, we talked about this concept of there are different ways of measuring the same thing. Here is the RSI, okay, relative strength index. Here's a different way of measuring momentum, ROC, rate of change. Here's a third way, CCI, commodity channel index. One is not better than the other, okay? One is not more accurate than the other. What you have to do is look at different ones and figure out what one do you like? What do you feel comfortable with? I feel comfortable with RSI and Bollinger Bands because I've been using them so long. That could be a good place for you to start. But I just wanted to put this up here because these are three of the most common momentum indicators or oscillators. And notice you can kind of see they're all kind of the same shape, right? They're just different ways of measuring the same thing. Spiked here, go down here. And the default settings, RSI is measuring 14 time periods. ROC is measuring 9 time periods. CCI is measuring, I think, 20 time periods. So we could kind of mess with these and change the default settings and maybe make them all set to the same time period. But what I really just want to convey is this, that you need to find what works for you, right? That's why I don't like these things like, oh, watch how I trade, pay to come in my trading room, blah, 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 blah. Big deal, It's whatever. What works for me is not going to work for you. What works for you might not work for me. Oh, look at this. Once again, support becomes resistance. I just can't get away from these levels, man. It's just so important to understand which levels are important. If you understand which levels are important and you understand momentum, it'll make your life so much easier. Now look at this. We get to support here. We're oversold. Buy signal. Oversold stocks that get to support tend to bounce. All right, let's go on to our next chart here. All right, now this is one of the kind of the cool things about charting is that it's got a fractal nature. The same principles apply regardless of the time frame, and that's because investors with different time frames come in and out of the market at different times. So here's Tesla, and this is a 5-year chart. This is measuring 14 weeks. These indicators measure time periods. Excuse me. So this is a 14-week time period. This is a 9-week time period. It's a 20-week time period. And this goes back 8 years. And we can see the same thing, all right? They all kind of do the same thing because they're just different ways of measuring the same thing. All right, darn it, come on, where's my pen? All right, there it is. So here, we got overbought, 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 right before a sell-off. Here, this is literally the most overbought that Tesla had been in its history from a day measured on a daily basis, and it was a good time to sell. Stock was at like $400 there. But anyway, I just wanted to put all three of these on the same page so you can just see that they're similar because they're different ways of measuring the same thing. And again, I'm gonna sound really redundant here and maybe get on your nerves, but if you want to learn, this is what you got to do. Repeat things. There's no one way that's the perfect way to do it. You got to find something that you feel comfortable with. My suggestion is spend a little time, go through your different indicators. I mean, on any charting software, they're going to all be there. These are all going to be on any popular charting software, and just look for what you feel comfortable with. Like say you're a guitar player. Are you a blues guitar player or a jazz player? It's still a guitar, but it's a very different style. Are you a classical player? Are you a flamenco player? What fits your personality? Now, this kind of is cool because it shows the fractal nature of trading. Now, this is a chart that is 5 days. And notice how the intervals here are 5 minutes. So this is measuring 14 5 minute time periods. This is 9 5 periods, and this is 20. Now, again, you could mess around with the default settings and change them and maybe get more accurate signals, but the same principles apply. And this is because we have different investors coming in with different time frames. Whether you're a long-term investor, short-term investor, swing trader, day trader, you're a human and you are going to experience the same emotions that humans of other trading time horizons experience. Okay, so if you didn't see this time frame down here, and if I didn't tell you, you wouldn't even know what this could be. A 5 year chart, it could be a 2 day chart, but it's the same thing. It's a fractal nature of charting. We get oversold, market moves higher. We get overbought, market moves lower. Okay, the fractal nature. It's pretty amazing, frankly. I mean, I get no matter. I mean, I've been doing this for 20, 25 years, and it still kind of amazes me. All right, enough of that. Let's go to one more here. And I just want to talk a little bit before I go about something that's really important. There are tools and there are rules, okay? The indicators are your tool. The rule is what do you do with it? You could say, "Oh, gee, Mark, it's overbought. Oh, it's overbought. Oh, it's oversold." Well, what the hell am I supposed to do? Well, here's what you got to do. This is I'm about to tell you, okay? You need to have a rule if you want to build a trading model. Okay. Now, what could be a potential rule? All right. Well, hey, if RSI and Bollinger Band simultaneously show oversold conditions, my rule is going to be when the stock closes back within the Bollinger Bands, that's when I jump in. Trading systems generally have a couple parts. You have what we call setup, which is like your pretend you're at a race. It's like the starter saying, get ready, get set. We have the trigger, which is the go, and then we have an exit strategy. Exit strategy for a profit, exit strategy for a loss. Now, right here, okay, we're simultaneously oversold on RSI and on the Bollinger Bands. What is the rule? Some might say, okay, well, my rule is going to be if we get a close back within the Bollinger Band, that's my trigger to buy. Someone else might say, hey, my trigger is going to be when the RSI gets back in the range I'm going to buy. So this is the thing. Like a lot of newer traders, they throw all these different things on their charts, and it just leads to confusion. Just keep it simple. Just pick 2 or 3 indicators, get really comfortable with them, and remember, trading is not about the tools, it's about the rules. What are you going to do? If you can't tell me or one of your fellow stockmarketjobber.com classmates here, this is why I'm getting into a trade, this is why I'm getting out of a trade, you're just guessing. And if you're just guessing, it's good. It's a good recipe for losing money. Okay. All right, everybody, that's it. Thank you so much. I hope to see you soon. I am Mark, the Stock Market Jobber, and please sign up for our YouTube page here. I will see you soon. Thank you, everybody.